So when are you forecasting, if at all, the next recession in the United States? There has to be one eventually, right?
Yeah, fortunately, our forecasting horizon doesn't extend beyond 2 years, so we're not forecasting one. So I think what's happening is that the lack of inflation is allowing the central banks to keep extending the cycle. So every time there is a downturn of some sort, then to the extent there's hawkishness, they reverse the hawkishness, and you get a big move in market yields. And so at the margin, that then does just enough to sort of avoid a recession. And that's happened basically 3 times now in the last 10 years. Now, this time is a bit more tricky because I think the nature of the slowdown we think is related to investment uncertainty. And so if you do get a slowdown now, even if you price back in some of the cuts that were priced in the market, it's actually difficult to get a response in investment through that because people simply don't want to invest in an uncertain environment. That's quite different from what happened in these previous episodes. So we'll see. Now, obviously, you know, the lower you start flying to the ground, so eventually once you start to run out of labor and you're running sort of sub 2% because there's no fiscal stimulus left, then the danger level goes up. But in our forecast, we don't have a recession.
And then what are you looking for in terms of, say, for example, S&P earnings upside if you're the economist, but you must be looking in terms of fundamentals earnings-wise too?
Yeah, so we actually have a sort of a bearish forecast on the first half of next year in the US. And so we actually have an S&P index target for the end of next year, which is below current levels, and it's partly because we have this air pocket in our economic forecast. We think there's going to be a correction at some sort. Now, we'll see. That hasn't happened this year. It's entirely possible that the equity market keeps going up, even if you hit some kind of air pocket. So equity, I think, is very, very difficult here. I think it's decoupled effectively from the fundamentals. So we think the U.S. might hit sort of a 0.5% growth first half of next year before then going back to trend second half of next year, and we'll have to see how the equity market digests that.
Okay, let's talk about this air pocket. You've got 3 Fed rate cuts priced in for next year. How do you get there? What has to happen to get the Fed there?
Yeah, and so having 3 Fed cuts as a modal forecast means the market's probably going to price 4 or 5, and it's pricing 1, right? So it's a huge move. So basically, we're saying history is going to repeat itself. So you had a shock to the manufacturing sector last year, which then collapsed Q4 growth. So you went to about 1% growth. You saw consumption slow down to about 1%. And it was because it was such a concentrated shock in one sector that you get a very outsized behavior response. So it's not just the people getting laid off that stopped spending.
This is the retail sector.
This was manufacturing last year and retail Q1, Q2. And where that shock is coming from is September tariffs. It's not the December tariffs. So the September tariffs are hitting the vulnerable part of U.S. retail. So 20% of the firms that we cover in the traditional bricks and mortar space have a margin of about 3%. You raise the input cost on their imports from China by 15%, suddenly you're not profitable. And so when we have discussions with the owners of those stores, they basically say, look, we're going to shut these stores down anyway over the next 5 years because of online retail penetration. But if they're not profitable now, I'm going to accelerate those store closures. And so we think that's something you could start to see in Q1 or
So in
Q2.
order for that not to happen, you have to roll back the September
You have to roll back September. And really the way we get to our forecast is the damage is sort of coming almost equally from the September tariffs, which is a retail story, and then from the May tariffs, which is sort of a manufacturing story. And you know, nominally, those are both sort of equally important.